Okay, it's 11 o'clock. Good morning, everybody. We'll get going. I've got a bit of news to cover. Then Richard's got some too. And then he's going to be interviewing our guest this week, who's Kathy McKenzie from Target Healthcare REIT. So, news first. It looks like a lot of funds, but it all relates to the same issue. I'll explain that in a second. And Odyssean, and then Richard's going to talk about Sirius. So, there's the chart for Chrysalis. Now, you've seen this one before because we talked about it quite a few times, but it's a decent size and on a quite a big discount, though that has been sort of narrowing very, very recently. Showed reach opportunities on here too. It's not on as bad a discount, but it's got the space the same sorts of stocks. I think it's kind of interesting. Molten Ventures I've got there. That one is on about the same sort of thing as Chrysalis. All very similar things. So basically, all of these things are invested in growth capital companies. And then you've got Edinburgh Worldwide, which is also invested in global small caps. Now, the reason we're talking about all of these today is because they all hold Graphcore, which was an unlisted investment, and it's just being bought by SoftBank. SoftBank are actually buying it with their own balance sheet, so it's not coming from vision funds. And there's a lot of talk about what they're going to do with it, but the key to it really is that it makes graphics processing chips, and it's a competitor really to NVIDIA. But for whatever reason, although the company would say that their chips are better than NVIDIA's are, they haven't been embraced by customers, and so the sales are negligible, and they've been losing money hand over fist. So SoftBank obviously owns ARM, so they're going to knock it together somehow, exchanging maybe not just merger companies, but definitely sort of exchange of technology and stuff, I think. And then try and make that bigger thing, but that's by the by because they bought it for cash. We don't know exactly how much they've paid. The implication is that it's in that kind of range of $600–700 million. That's a long way down from where it was valued at the peak. So that was in 2020. It was valued at $2.5 billion. For Chrysalis, they get about $55 million up front, and then there's some deferred payments. And I think everybody's deal is structured the same way. So there's a little bit of deferred income here too, potentially. That $54.8 million translates to £43.8 million, which is quite a decent premium to the value that they were carrying as at March 2024. So they were earning at 35.1 million. And so that adds about 1.5p to the NAV. But unfortunately, it means that they've lost money on the investment all round because they've been quite a long-standing investor in it. So that's really good news that they've freed up all this money. But at the same time, they've said, well, we did put 10.5 million euros to WeFox. So now they've got the 50 million that they wanted to have of liquidity in their cash reserve. And the idea was once they've got that, anything more they get, what they're going to use to do buybacks and to try and bring their discount down. Because they put the money to WeFox, that they can't start doing that yet. That's been pushed back until we make the next disposal. But I think the next disposal is likely to be much more material than Graphcore. So what it's going to be, we don't know. It might be Klarna, it might be Starling. There's a whole bunch of different things that they've got that are relatively mature and doing quite well. And they're going to be much bigger disposals than Graphcore is, and then that's going to make the difference to the discount theory. For Schroder Opportunities, it's a much smaller deal. It's a much smaller fund. So they invested about 3 million quid in 2020. So that would have been more or less the peak valuation. But because the way that their deal was structured, they put it into preference shares. They're going to get back the value of their original stake, less than expenses. So they haven't really lost money on it overall. And because they've written it down already, they're writing that up, and that's going to add about 0.75p to their NAV. For Molten Ventures, they're freeing up $26 million. I think the interesting thing here is that whereas the other two, there was quite a big uplift, they were already valuing it around this kind of level. They've been invested for a long time as well. So they have lost money as well. And again, they've said, well, we've made two other exits recently, so we're announcing these today. Again, also fairly close to current valuations. That to me says that the Molten Ventures NAV is a lot sort of less conservative, let's put it that way, than something like Chrysalis or the Australian Pension Opportunities NAV is. We don't talk much about Molten Ventures. It's not in the Morningstar stats. We don't normally cover it. It's something we've been thinking we ought to probably do. We might do something more on that in future. We'll see how we go. Lastly, Edinburgh Worldwide, they haven't put an announcement out. They hadn't put an announcement out when I put the show together. It's not a very big holding for them. So it was only valued about £3.7 million at 30th April. I wouldn't be surprised if they're going to write that up as well. So there'll be a little uplift, but that's tiny in the great scheme of things. So it's good to draw a line through this. It's been a disappointment the last couple of years, definitely. It's a great shame. Could have been sort of like a great British company, but didn't work out. But anyway, freed up some money and time to move on. And then the only other one I wanted to talk about was Odyssean, small cap UK small cap fund, 200 million market cap, trading around asset value, and it's been fairly sort of stable share price for a while now, and the trading close to asset value for a while now too. And so it has been able to issue some stock, but they've got demand from an investor. We don't know how big that investor is, but that investor wants to put some money into the company, and so they're going to do a placing of shares to professional investors to that money in that way. And at the same time, they're going to do a retail offer along the side of it. So the new shares being issued are going to be a 1% premium to NAV. That announcement will be made on the 17th of July what the price is going to be. So we don't know what that is yet. Part of the attraction, I suppose, is that there's no stamp duty, but you see, trading at 0.9 premium, it's really not far off just buying shares in the market. That's the sort of first thing to note. If you want to apply for stock in the retail offer, you have to do it through Winterflood's wrap platform, which is the thing that they've set up to deal with private investors. The whole thing's being done under this EU rule that lets you issue stock, retail stock, up to 8 million euros. It's something that we inherited from the EU that we just rolled over into UK legislation when we left. And it's incredible to me that we haven't got around to revising this yet. It needs to be a much bigger number. The traction is they don't have to issue a prospectus. That's why they want to do it this way. If they was more than 8 million euros, they have to issue a prospectus, and that costs an awful lot of money. But they can get around it doing this. I think that 8 million euros number needs to be a lot higher, but there we go. So the wrap offer closes at 2 p.m. on the 17th of July, so there isn't an awful lot of time to think about this. And I can see why it's trading at asset value, because these are all the UK small cap funds ranked by 5-year returns. And it ranks third. But actually, I don't want to, I really want the sector to grow. I do think this is great. I think it's great this is happening. But one, you can buy the shares at more or less the same price in the market anyway. And two, the recent performance of this fund has not been as good as it has been over 5 years. So over 3 years, it's 8th out of about 23 funds. Over 1 year, I think it's 18th out of 24 funds. There are things that have done an awful lot better than it recently that are much, much cheaper. And if you want to buy UK small cap, I suggest you look in this sort of area, really, rather than down here. That's my opinion, and up to you. So that's all I really wanted to say. I'm going to hand over to Richard now and let him drive. So he's going to share the presentation from his end.
Great, thanks, James. Right, let's get this going. Cool. Okay, so yeah, just wanted to talk about Sirius Real Estate. So they've raised some money this week. So this is their chart. So big company, 1.3 billion, trading on a slight 5% premium, which is not that common amongst the real estate companies at the moment. So we'll go into why I think that is in a sec. But they do their job well, and they're very good at it, and they're very focused on what they do. So for those who don't know much about them, so they own business parks and sort of light industrial estates, predominantly in Germany, but in the last couple of years they come into the UK market, and it's really a sort of value add business model. So they buy at high yields, sort of low vacancies and things like that, and they put a bit of capex in and fill up that space, and then either refinance that to release the money or sell it at lower yields, and then recycle that through, sort of rinse and repeat, basically. So since 2014, you can see sort of their track record there. So they've acquired 58 assets for just under 900 million. And then sort of 10 years later, that's worth almost 1.3 billion, sort of 46% uplift. And in that time, they've sold 14 of their assets, sort of 67% uplift. So that's the business model. It's working really well. So 10 consecutive years of rental growth of 5% or more across the portfolio. That's led to 10 consecutive years of annual dividend growth, which was nicely covered by earnings. And there's their 10-year sort of NAV total return and share price total return. So really quite impressive over that period. And on the balance sheet as well is in quite a strong position. So that's why we feel they're trading at a decent premium. So this week they've announced and then raised 150 million at 94p per share, which is a slight discount on the closing price, but in line with their NAV at the end of March. The retail offer also raised an extra 2.5 million. So they got as much as they wanted in both bits there, and those shares will be admitted early next week. And this follows a raise that they did at the end of last year that got a similar amount, 147 million, and a bond issuance earlier this year for another 60 million euros. So investors seem to be happy with what they're doing, and they're taking advantage of that and growing. So they deployed the equity raise from November into 11 assets, mainly in the UK, and they say they've got a near-term pipeline which they'll spend this money on. So 2 assets in Germany and 3 in the UK, and then a medium-term pipeline worth over 100 million euros. And yeah, again, they'll do exactly what they've done before: under-rented properties with high vacancies, put some capex into it and grow the rents, and yeah, probably look to sell it in a few years' time. So that is them.